Welcome back to the deep dive. Today we're plunging into, well, a really interesting company at a fascinating crossroads. Air products.
Yeah, they're in this unique spot, aren't they? Supplying essential industrial gases like oxygen for hospitals, hydrogen for refineries, kind of the bedrock stuff.
Exactly, foundational. But at the same time, they're making these absolutely massive bets on the energy transition future. Huge projects.
That's the core tension. So what we've done is dig into their latest fiscal 2025 earnings call, looked at the slides, and boiled it down for you.
Our mission for you, the listener, is to really get a handle on this dual strategy. How are they driving efficiency in that profitable core business?
And maybe the bigger question, how are they managing the sheer scale and risk of these multi-billion-dollar clean energy ventures? NEOM in Saudi Arabia, the Louisiana Blue project here.
Okay, let's unpack this. First things first, let's set the baseline. How did they actually do in fiscal 2025? Because context matters here.
Right? They actually hit their targets. Finished the year pretty strong, in fact. They exceeded the midpoint of their guidance. Adjusted earnings per share came in at $12.03.
$12.03.
Okay, and that's backed by some solid performance in the core business. Their operating income margin was 23.7%.
Pretty healthy margin.
Yeah, and return on capital, ROC, hit 10.1%.
Yeah.
Look, even with all the spending on big projects, they still returned $1.6 billion to shareholders.
And that dividend track record is just remarkable.
It really is. That makes it, 43 consecutive years they've increased the dividend. It shows a real commitment to stable returns, even while they're making these big strategic shifts.
That financial strength really sets the stage for this strategic pivot we're talking about. Seems like starting around Q2 of FY25, management really signaled a refocus back to the core industrial gas business.
Yeah, a decisive shift. They're talking about three pillars: productivity, pricing, and disciplined capital allocation. But discipline feels like a bit of an understatement when you see the headcount numbers.
Right. The workforce changes are pretty stark.
It's more than just a pivot. It feels like a full course correction almost. They launched this massive workforce efficiency program. Get this. Since 2022, they've identified 3,600 employee actions for reduction.
3,600. Wow. What percentage is that?
That's 16% of their peak workforce, 16%. They're aggressively right-sizing the organization. Seems like they're preparing for lower capital spending down the road and trying to fight off some internal inflation too.
16%. For a global company like that, it's stunning. Suggests maybe they got a bit ahead of themselves during the big project buildup phase.
It could be. But the goal seems clear. Boost profitability and, frankly, speed up decision-making internally. Cut through some bureaucracy maybe. The payoff, the kind of aha moment for investors, is the cost savings number.
What are they projecting?
They expect this whole restructuring to generate about $250 million in annual P&L cost savings once it's fully done.
$250 million a year. That's a serious internal lever they can pull, regardless of what the broader market does.
Exactly. And if you translate that to earnings, they estimate it'll add up to about 90 cents in cumulative earnings per share benefit by fiscal 2027.
90 cents a share just from internal efficiency.
Yeah. And their goal is interesting, too. They basically said they wanted to get back to staffing levels around, say, 2018, but adjusted only for the people needed to run the new plants coming online, minus any gains from things like AI or automation.
So do the same or more with significantly fewer people.
That's the message. It definitely links into the capital allocation reset you mentioned. After years of really historic CapEx levels launching these huge energy transition plants, they're signaling a pretty steep cutback in future spending.
Where are they aiming long-term?
It's a dramatic shift. The long-term target for CapEx is roughly $2.5 billion per year. That's the goal after these current big projects wrap up.
$2.5 billion. And how much of that is just keeping things running?
Good point. About $0.6 billion of that is just maintenance CapEx, keeping the existing plants safe and operational, the basic.
Okay, so that leaves less than $2 billion, maybe $1.9 billion for actual new growth projects. That definitely signals a move away from just chasing growth at all costs.
Precisely. And they expect most of that, around $1.5 billion a year, to go back into their bread and butter, traditional high-return industrial gas projects.
Like air separation units, standard hydrogen plants, the stuff they know really well.
Exactly. And critically, those projects tend to have much faster execution times, right?
Yeah.
Maybe 18 to 30 months. So the capital gets deployed and starts earning returns much quicker than, say, a 7-year mega project.
And we're already seeing that shift start. The spending numbers are coming down.
Yeah, they are. They spent $5.1 billion in FY25. But the forecast for FY26 CapEx is already down to around $4 billion.
So hitting the brakes while still finishing the current big builds.
That seems to be the plan. And they've been very clear. Any new project has to meet strict return criteria. And crucially, needs a very high percentage of its output already contracted to good customers before they'll commit significant new money. De-risking is the name of the game.
Okay, speaking of huge commitments, here's where it gets really interesting. Let's talk about those mega projects. First up, NEOM Green Hydrogen in Saudi Arabia.
Yeah.
Massive scale, massive ambition. What's the latest there?
The news on NEOM sounds pretty positive, actually. They're saying it's progressing well, about 90% complete now.
90%. Wow.
Yeah. This thing involves a huge amount of renewable power generation, right? Solar and wind. They expect that part to be done by early 2026.
And then?
Then they start commissioning the electrolyzers, the ammonia production.
Yep.
That kicks off right after the power is ready. They're targeting full product availability sometime in 2027.
Okay, so you make all this green ammonia way out in the Saudi desert. How do you actually sell it? What's the plan to get it to market?
Well, the initial plan is just selling it as green ammonia. But the bigger strategy involves shipping it primarily to demand centers like Europe and Asia.
Right.
And in Europe specifically, they're watching the regulations very closely, particularly the RED mandate, because the plan is to pursue ammonia dissociation or cracking at receiving terminals there.
Okay, for listeners maybe not deep in hydrogen logistics, why ship ammonia and then crack it? Why not just ship hydrogen?
Good question. Because hydrogen is just notoriously difficult and expensive to ship long distances. It's super light, low density. You need extreme compression or liquefaction at incredibly cold temperatures.
Right. Costly.
Very. Ammonia, which is NH3, is basically hydrogen packed with nitrogen. You can ship it as a liquid much more easily at warmer temperatures, much cheaper. It's like a chemical container for the hydrogen.
So it's an efficient shipping method.
Exactly. And cracking is just reversing that at the destination, turning the green ammonia back into pure hydrogen fuel where it's actually needed.
Yeah.
For transport, industry decarbonization, whatever the use case is.
And this leads to that market scale number that really jumped out at me from the materials. The EU's RE3 mandate, it only requires 1% of fuel sold to be these RFNBOs by 2030.
Right. Renewable fuels of non-biological origin, basically green hydrogen or things made from it. And that 1%, it sounds small, doesn't it?
Tiny.
But that 1% alone would create demand for green hydrogen. That's roughly 7 times the entire production capacity of the NEOM project.
7 times NEOM just for 1% in Europe. That context is mind-blowing. It really shows NEOM isn't the answer. It's maybe a first big step, but the market potential is just orders of magnitude bigger.
Absolutely. And that's why Air Products seems so confident about NEOM's long-term prospects. They keep emphasizing that their model shipping green ammonia from Saudi, cracking it in Europe, is price competitive without needing public subsidies.
That's a huge point, being independent of shifting government support.
It's a massive advantage in this, still very early market. Gives them much more certainty.
Okay, let's shift back home now to the Louisiana Blue Hydrogen project. This was supposed to be a flagship U.S. decarbonization effort, but it's currently on pause. What's the plan B? What's the contingency?
Yeah, they hit a pause on making new commitments back in Q2 of FY25. So any spending you see in the FY26 forecast is just for stuff they were already locked into. The bottom line is that project only goes forward if, and only if, they sign firm long-term contracts for the hydrogen and nitrogen with, really high-quality customers. Customers that guarantee the project meets those strict return hurdles they've set. If they can't get those deals inked, it stops.
And they're even looking at changing the whole structure, maybe selling off parts of it to de-risk further.
Yes, that's the really interesting strategic move here. They're actively looking at proposals to divest 2 key, quite specialized parts of the original plan.
Which parts?
The carbon sequestration assets, basically the rights and planned infrastructure for injecting and storing the captured CO2 underground, and the ammonia production facilities.
So selling the CO2 storage part, what does that achieve for them?
It fundamentally changes the project for Air Products. By selling off the CO2 pore space and the ammonia loop, they transform it from this huge, complex blue ammonia plant with massive carbon capture and storage liabilities.
Which has a lot of regulatory uncertainty and long-term risk.
Exactly, into something much more like a standard, large-scale air separation and hydrogen supply project. It dramatically simplifies their risk profile, cuts their required capital way down, and lets them focus just on their core skill, building and running the gas production plant itself.
Makes sense. They're aiming for a final decision by the end of 2025, right? But what if they just walk away completely? They've already spent quite a bit, haven't they? About $2 billion sunk into it so far.
Around $2 billion, yeah.
Hmm.
On engineering, equipment orders, acquiring that poor space, it's a lot of money.
Is that just gone, written off?
Not necessarily all of it. And this
Huh.
kind of speaks to their discipline, maybe. Management estimates that even if they cancel the whole thing, they could probably monetize, sell off or reuse about half of those sunk costs.
50% recovery. That's significant.
It is. It suggests that money isn't just vaporized. It represents actual physical assets, vessels, compressors, detailed engineering plans that have value and could potentially be sold or maybe even redeployed to another project somewhere else. Gives them a stronger hand than just writing off the full $2 billion.
We should probably quickly mention, too, they are still pushing ahead with some other big projects that have had challenges, like the one in Alberta, even if they're underperforming expectations.
Correct. Yeah, despite cost issues on some of these, they're committed to finishing them because of existing long-term contracts. Alberta's a good example. They have, I think, 50% of the volume already committed to a major customer there.
So contractual obligations trump the immediate cost pain sometimes.
Often, yes. They still need to spend about another $2.5 billion combined on these specific underperforming projects through 2028. And they acknowledge these probably won't add much to operating income right away, but the contracts lock them in.
Okay, let's pivot then to the immediate financials. The outlook for fiscal 2026, what are they guiding towards? Growth.
Outlook is generally positive. They're targeting high single-digit growth. The adjusted EPS guidance for FY26 is in the range of $12.85 to $13.15.
Okay, $12.85 to $13.15. What's that translate to percentage-wise?
That works out to about 7% to 9% growth compared to FY25, so pretty healthy.
But here's the key thing, right? They're baking in an assumption of minimal market growth overall, citing macroeconomic headwinds. So if the general economy isn't lifting them, where's that 7-9% growth actually coming from?
Good question. It's mostly driven by internal factors and contributions from new plants coming online. They figure about 2% to 3% of that growth will come just from new assets ramping up, especially in Asia and the Americas.
Okay, 2-3% from new plants.
The rest, the other, say, 5-6% or so, is expected to come pretty evenly split between those productivity gains we talked about, that $250 million annual savings drive, and specific pricing actions they're taking.
So internal levers, cost-cutting and pricing power.
Primarily. And there's also a small tailwind they mentioned from cleaning up the portfolio.
Right, selling off some assets.
Yeah, they expect about a plus 1% benefit from selling 2 underperforming coal gasification plants in Asia. These are assets they'd already written down in FY25. So getting rid of lower margin non-core stuff helps streamline things and gives a little boost to the overall margin profile.
Okay, but it's not all tailwinds. We have to talk about the helium problem. It just seems to keep dragging on them. How bad is it looking for FY26?
Still a significant challenge, yeah.
Yeah.
They're actually forecasting a headwind from helium in FY26 that's pretty comparable to the hit they took in FY25.
And how big was that hit in FY25?
It was substantial, about $0.49 per share impact. So nearly 50 cents wiped off the EPS just due to helium market issues.
Wow, and that's expected again. Why is it so bad? Is it just supply and demand or something else?
It seems to be due to lower global demand overall and just unfavorable volume and pricing pretty much everywhere they operate. But they also view it as kind of structural now, not just cyclical.
Structural. What changed?
Management pointed specifically to the big shift in the U.S. market. The Bureau of Land Management, the BLM, getting out of the helium reserve business. Historically, the BLM held this massive strategic helium inventory, acting like a buffer for the global market.
Right, they could release supply if there were disruptions elsewhere, like a strategic petroleum reserve, but for helium.
Exactly. So when the BLM basically exited that role, that huge stabilizing inventory vanished. It left the global market much more exposed, much more volatile, and sensitive to any little supply disruption from other smaller sources.
So no big buffer anymore means more price spikes and uncertainty.
Precisely. Since the supply side got more decentralized, you see these wild swings. They don't see it stabilizing quickly either. The best guess they offered was maybe things calm down sometime in 2027.
2027. So it's a key drag on earnings for the next year or two at least.
Looks that way. Definitely something to watch.
Okay, but let's end on a stronger note for the core business. Where are they seeing real resilience? Which parts are performing well?
Electronics stands out, definitely. It's about 17% of their total sales, roughly, and it's a high-margin, really critical segment for them.
supplying gases for semiconductor manufacturing and things like that.
Exactly. And they're really riding the wave of global investment in chip fabs. They mentioned strong ongoing investments, a solid project backlog, especially in Asia, places like Taiwan. They're busy commissioning new plants, winning long-term supply deals. It remains a really robust part of the traditional business.
So what does this all mean? Let's try to synthesize this. Air Products is clearly executing a pretty decisive, maybe even aggressive pivot here.
I think that's fair. They're really tightening the belt internally, trying to squeeze maximum returns out of that core industrial gas engine.
Yeah.
Disciplined capital, serious productivity push, that $250 million annual savings target is clearly fundamental to their near-term EPS growth story.
While at the same time, they're getting much more, let's say, pragmatic about these huge clean energy dreams.
Yeah, pragmatic is a good word. They're working hard to de-risk NEOM and especially the Louisiana Blue project. Shifting the burden, demanding partners step up and guarantee those returns before they commit more capital.
And that willingness to potentially divest key parts of Louisiana Blue, like the CO2 storage, that shows they'll simplify drastically if it means hitting their financial targets. They want the right returns, as they put it.
Right. It's less about planting flags and more about securing profitable, de-risked contracts now.
Which brings us to the final provocative thought for you, the listener. This focus on the right returns is clearly the central tension. So consider this. They're aggressively trying to de-risk Louisiana Blue, demanding firm customer contracts, maybe even selling off the trickiest bits. But management themselves noted how hot the U.S. construction market is, competing with data centers, battery plants, everything.
Yeah, inflation and labor costs are a real challenge.
So, if they find partners willing to sign those offtake agreements for Louisiana Blue, but construction costs keep spiraling upwards due to that competition, at what point does even a strategically important blue hydrogen project just become too expensive to actually deliver those right returns they insist on?
That really is the million-dollar question, isn't it? Or maybe the billion-dollar question in this case. It'll be the ultimate test of this new capital discipline mantra. They've signaled they're willing to walk away, even write off maybe $1 billion in sunk costs.
The question is, will they stick to that threshold if push comes to shove, especially with the strategic importance of building these domestic clean energy assets?
We'll likely get a much clearer picture before the end of 2025 when they've promised that final decision update. Definitely something to keep a close eye on.
A great question indeed. And that's all the time we have for this deep dive. Thanks for tuning in.
Thanks, everyone.